Almost afternoon. I'm from DC, so I'm pretty much at like 4 p.m. in my brain right now. But thank you for sitting in on our panel, the first panel of the day. We've had some really great speakers, and I'm excited to get started on this panel, a little different and all encapsulating on the market, the lodging market here. So you can see each of our panelists on the stage. We won't take up too much time doing introductions, but I would like to show, obviously, who each is. So from the end here, we have Jennifer Dakin, Erik Eveleigh, Smedes Rose, Rachael Rothman, and Jay Newman here with Athens Group. And actually, Jay is working on the Miramar Hotel redevelopment plan, so right up the street with MSD Partners, which is exciting. So he has a lot of local knowledge, too, on the market here. So capitalizing on the strength in lodging. What does that mean? Well, really, we've obviously seen lodging take a huge rebound and gains this past year in performance, coming up from the depths, so to speak. And a lot of what drives those changes are obviously from travel or investors. So we'll talk today about kind of all the stakeholders who are involved. We'll start with kind of the trends and momentum that's been created over the past couple of months. And Rachael with CBRE, she's our data guru, so we'll kind of kick it off with her if she could kind of give the historical background as well as where we're headed.
Sure. Okay, so a couple things that you guys probably all know out there about the industry right now, specifically in luxury. Historically, it's been the only category that's been able to price to offset for inflation. And now we are seeing inflation at the highest levels that we've seen in decades. We are continuing to see strong pricing power in the luxury segment. Given the labor constraints, and I know there are some of you here focused on optimizing labor, so I would definitely reach out. But given the labor constraints, we're seeing some of the hotels curtail on the full occupancy levels that they can achieve, and instead really trying to push rate and use that to enhance their profitability. And it's something that we expect to continue to see as we move forward over the next year or two at least.
Sure. And then certain types of properties or geographies, are you noticing any changes or any geographies that are really kicking off and going strong? Okay,
so ultra luxury is doing amazing. So the very highest price points are doing exceptionally well. Something over $1,000, $2,000, $3,000 a night. They are all sold out. In terms of what geographies are doing well, of course, the drive-to resort destinations are doing exceptionally well. It will be interesting once global travel becomes a bit more frictionless, which is not something that we're seeing right now. It could be that people begin to venture out again more, I'm hopeful, and that may mean slower growth going forward for some of these regional markets. But right now, if you're in a Phoenix, Miami, Fort Lauderdale, Jackson Hole, Santa Fe, these are markets where people want to be, and they're doing exceptionally well. Santa Barbara. So if you are a high-end resort in a drive-to market, this is your heyday for sure.
That's good to hear. Jen, you obviously look at a lot of deals, underwriting, trying to piece all the puzzle pieces together. Have you noticed certain deals more attractive in the sense of property types or different brands or different amenities they might have that are really appealing to you and your team?
Sure. So I work for Wells Fargo, and we finance both public and private. Well, our clients are both public and private, but 60% of our portfolio are private equity firms and private real estate owners and operators. And so we kind of covered the gamut, more mid-scale to luxury. We don't focus as much on economy, but economy and the upper upscale and luxury have been performing very well. As Rachael alluded to, those drive-to markets, destination markets, beachfront, the Smile States, have all been performing very well and where we've kind of concentrated in terms of doing financing. So it's people, there's so much pent up demand. People want to get out of their homes. They want to go on vacation. You're also seeing family oriented places that are, again, like on the beach, family friendly activities, really in demand right now.
Great. And from Erik, I want to get your opinion too, just given that luxury has kind of transformed, I'd say, over the past decade or so, even before the pandemic, and what we've seen lately in the sense of performance rebound. But with Hilton, there's been several brands obviously introduced throughout the years. What would you say is the push for different luxury type of brands, and that being property types or location and resort versus urban or things like that?
Yeah, I think there's definitely been an ebb and flow of the popularity of brands, specifically hard brands, over the last couple of decades. And I think before this pandemic, there was certainly a desire to be more bespoke and be more independent. And you saw a lot of brand companies try to address that with soft brands, or really blending the idea of soft brands and local authenticity into hard brands. So that hard line between what it means to be a hard brand, especially in the full service and luxury space, really is blurred. So that you might have some calling cards of what the brand represents from a service perspective or from a programming perspective, but really the product and the guest experience really feels independent, really feels one of a kind. So the brands are really going in that direction. I think what that means is the popularity of the brands and the hard brands are coming back because that difference is less obvious. And so what you get is you get that comfort of the brand, the engines of the brand is really the appealing part to the owner. And to the guest, they don't really understand or see the big difference between sort of an independent and a brand.
Yeah, and performance tracking of those, and Rachael, you probably have some insights too, just given the breadth of data you see. Is one more appealing than the other in long-term growth performance in terms of soft branding or hard branding?
I think it really depends, and we'll talk about this a little bit later, but when it comes to mixed use development, certainly the hard brands I think have an advantage, whether it's resorts or in an urban environment that relies on group business or corporate business. The hard brands I think have an advantage because of that familiarity. In the resort space, we're really pushing our independent sort of soft brands in that way, because they do offer that one of a kind experience that is very much unique, and the programming is so unique that it's hard to really fit into a brand.
Sure. And Rachael, do you second that in the sense of which brands have or not brands, but maybe types of branding or soft branding have performance growth metrics?
I mean, I think over the pandemic, we've seen brand.com really show its strength.
Okay.
And I know, 40 years ago or however many years ago I went to hotel school, they used to tell us that the brand was considered occupancy insurance.
Yeah.
And, the brands took it on the chin like everyone did. But I think that largely held true. I mean, those are the ones that did perform better. They did take share. There was some growth in OTA usage, but I think that was largely because of the propensity to shift from corporate to leisure. Right. It wasn't that OTA was taking share because people wanted it more. Yeah. It was that brand.com actually people felt more comfortable with, but the shifting in the business led to growth in both categories. Yeah. But I mean, I would think in a pandemic, domestically and internationally, a brand would give you that comfort. And I'd be curious what you all think, but I think as you venture outside of the US, like brands have more power. Like if people are gonna go, I don't know, to a new destination in Mexico for the first time, they're gonna feel more comfortable going to a branded experience. And I know you all have been growing a lot in that category.
Yeah, and certainly in a health epidemic and coming out of one, I think beyond sort of occupancy insurance, which I think lends to lender comfort as well in a lot of ways. It's protocol comfort and cleanliness comfort and security comfort.
That's what drove the occupancy, right?
Right.
Yeah.
That helps as well.
Yeah.
At least that's what we're telling ourselves.
Right, and brand standards, it's additional support.
Sure.
Also then too, luxury assets are seeing a lot of hotel residence combinations. I'm curious from Jay, who obviously has a lot of mixed use and development knowledge, and your projects that you're working on right now, I'll see this. How do you look at whether or not you should bring in residences to a project?
Well, residences, it's critical. It's critical for financial reasons, and then I know this is an overused word, but there really is synergism between luxury residences and the luxury hotel. If you have a freestanding hotel-branded residence, you still cannot provide the same F&B experience. You can't have a true spa experience. Maybe you have a really nice fitness center. Maybe you have one restaurant on site. But the minute you get those shared facilities, shared amenities, you actually drive tremendous premiums for your residences. Our experience across multiple luxury brands has been a 25% to 100% market premium. And that's because you can get 24-hour room service, or if you need that gown or a suit pressed for a charity event, and people still dress up for charity events if and when they happen, you can get that service. And it's also the recognition factor in the facility. So we try to have, whenever we can, both for financing purposes, bottom line profitability, and overall support. Those residents, they may not be there 52 weeks of the year, but they're some of your best customers, and they bring a lot of people to the property. And it's a lot easier to have someone sometimes stay in the hotel room beneath your residence than it is in your residence. So it is paramount for these very luxury, expensive projects that we get involved in. For example, the Miramar here that we've been working on with MSD Partners for a number of years. Right now, this is a 302 guest room hotel, and our development plan, which has been approved and is being finalized at California Coastal Commission, is to expand the number of hotel rooms by just a handful to 316, but we're going to have 60 residences. Okay. So there's tremendous demand. Not to say a freestanding hotel branded without a hotel residence doesn't achieve a market premium. It's just not the same premium.
Sure. And Smedes, I saw you shaking your head in the sense of the upside or the increase there, premium with the residences. What's your thought?
Yeah, I mean, just by way of background, I only look at the public companies, publicly traded hotel companies, whether they're the brand owners or the real estate owners. And we've definitely seen some of the publicly traded REITs move into owning the hotel, and they don't own the residential portion, but it's considered a very big driver of the hotel returns to have that residential portion. The brands like it because they participate in the first-time sale of the residential piece. And the hotel likes it because, as Jay mentioned, I mean, it helps support the overall, particularly the ancillary services of the full-service luxury hotel.
Yeah, I'd like to mention one thing. Everyone who's publicly held, obviously, is concerned about growth. And what better way to grow a hotel company than to get into the residential business? You may not be the developer, you may not be the owner, but you can drive a percentage of the sales proceeds anywhere from 4 to 9%. That's, in a sense, found money, not to mention the income stream from whatever operations you have. And for example, Waldorf, with that Erik has got with Hilton, they're in that business, and a number of the others are. So if they can't, they're growing both with hotel rooms, and now they're growing with freestanding residential projects. And
when would a residence not work? And Erik, maybe too, you might.
I think it doesn't work when the nuances of what it means to be the branded residence, those services that are provided, the program elements that are necessary to not sort of dilute the brand experience, that they're not provided on a long-term basis. I think with the hotel, there's less risk, so in a lot of cases it does work. When the hotel works in that market, the residential should as well. They should coincide. When you start to get into standalone branded residences, which as Jay said, can be very lucrative because rather than a 50-year cash flow of fees, you're getting those license fees within 3 or 4 years. So it's very lucrative. But at some point, enough sales, it turns over to an association. That association has to pay assessments, and if that's out of market, very quickly the first thing they do is begin to pick off program elements, service elements, and then you begin to dilute the brand. So I think it doesn't work. I think when there's enough of a unit mix or unit count to override the assessments that are going to be there long term, that are out of market from a pricing perspective, and then you want to avoid that conversation around diluting the brand ethos and the brand provisions of service, for those properties.
Sure.
Yeah, I just want to make one comment because you touched on it. It's the dilution factor. Every time we have a luxury hotel project with or without a residential component, we're always looking at the brand and we're saying, do they have brand integrity? Or are they just growing the brand for earnings sake? And that's also popping up now where you have a luxury brand, at least in the extreme area we deal in, and are they showing up on every corner basically? And that exclusivity factor is critical in driving those premiums. So I do think we could reach with some brands a point of no return where they've just gone too far and they have lost sight of the value of the brand, and there could be a backlash to it. So that's something we really follow a lot and debate all the time.
Interesting. So I guess then coming out of this, it sounds like luxury in residence is a true winner if it's the right mix or the right site and things such as that. Are there any other segments that you, maybe to Jen, you could speak to this in the sense it's just a sure, clear green checkbox in types of different assets or location?
Well, like I said before, beachfront. Anything on the beach has just been performing phenomenally well. And it doesn't matter if it's a Spring Hill Suites or, a Four Seasons. They've been doing very, very well.
Are there any losers in the pot? Like maybe something that you guys just aren't really seeing? And I'm speaking to Jen then and Smedes too. And Jay too, if you have comment, like a location or a type of asset you're just not really connecting with and you're not going to spend your time on it as of late, current.
Yeah, I mean, it's been extremely difficult. The CBD markets are just, there's no corporate demand. Mm-hmm. So as those assets and those owners have been, frankly, suffering and have been very challenged over the past year. Those group boxes that really need the convention center business and things like that to help generate revenue, they're just challenged right now. Now, gradually, I think you're starting to see signs of growth, but it's going to be slow going, and it's going to take another 3 to 4 years for that probably to come back.
Sure.
But there's a lot of uncertainty in the market, especially in downtown areas.
Sure. And Smedes, the RevPAR sustainability and things like that in terms of upside.
Well, what we've seen is kind of similar to what's been said. When you look at the publicly owned portfolios, anything resort, drive to, Sunbelt, it's off the charts. Rates, especially at the high end, are well above 2019 levels. And then when we look at the large kind of downtown urban assets that have a huge group component, I mean, they're just a disaster. But they are, sequentially getting a little better. Third quarter was a little better than the second quarter, but they're way below 2019 levels, particularly on profitability. And then on the luxury side, what we've seen with the public companies is they, even pre-pandemic, they were trying to move their portfolios upscale into the more luxury. But generally, I would say, again, just for the public owners, they don't really want to be in the hard brands. It's more kind of a soft brand, a luxury-like asset. Maybe it's lifestyle boutique, but they don't really want to be locked down with the really hard standards of like a Four Seasons or a Ritz-Carlton. So, we've seen some movement in those branded kinds of properties, but in general, I would say, it's a little bit of a tough nut to crack.
Sure.
If you're a publicly traded company and you probably don't want to be just in the luxury, like really high-end, hard luxury branded.
Is that just because of bottom line and the fees and
it's
the
expensive.
renovation? And
it's hard to run.
Yeah.
There's just a lot of required staffing, a lot of required brand standards. So if you can move into more of a soft branded, you have a little more flexibility, and you can probably charge like a luxury hotel, but you don't have the same kinds of expenses. I mean, this is very broad.
Right.
But we did see Four Seasons Orlando trade at a big multiple. So, I mean, they're trading, but in general, that's where you see kind of the strategy from the publicly owned REITs primarily.
Sure. And then who is the buyer and seller market, or who are you seeing in these trades? Is there a certain genre or class of stakeholders that are looking at buying or selling right now?
Well, we see, the public guys have been fairly active, but the private equity guys have been very active. I would say, hotels always trade at a spread to other real estate classes because it's just inherently more risky. But that spread is really widened. I mean, like I follow self-storage as well, for instance, and self-storage cap rates are like routinely 3.5%. Luxury hotels are probably more like, 7. So, I mean, it's a big spread, so it's attracting a lot of capital.
Sure.
Yeah, let me just add to that. I mean, I'm not sure about the spreads you're seeing or what we're seeing, because we're in the market, is the cap rates for luxury properties, luxury resorts, in our case, are sub 3. And who are those buyers? They are private equity, but in many cases, it's really the family office, which is a form of private equity. And in many cases, it's high net worth individuals. COVID is a whole story in and of itself, but I think what it's done is it's changed people's perspectives on life, lifestyles, family, and people are gravitating to trying to find a little more balance. And it's a luxury resort, luxury hotel is like a piece of art, and it's something you can enjoy, you can share with friends. So there's a tremendous amount of interest from high net worth individuals who view these as trophy assets that are irreplaceable and places that they enjoy. Our partner in our project we just announced in Naples, Florida with Four Seasons is the same partner we have here, which is MSD Capital. That's Michael Dell, his family office. They own a project that we did in Kona, the Four Seasons Eveleigh. They also own the Four Seasons in Maui, and they purchased recently the Boca Raton Hotel. And there's many people like Michael Dell who want to be in this business. And as we said earlier, in an inflationary economy, there's nothing better than a hard asset, and a hard asset that you can reprice on a daily basis. So I think there's some real strategic advantages to the ultra luxury product that you may not have with other asset classes in an era of uncertainty.
I just wanted to clarify when I mentioned the spread on cap rates, we're looking at 2019 valuations, which is very much, at least the buyers we see are using 19 as their first sort of benchmark.
Sure.
And then they'll talk about when they can get back there. And then there's no reason to assume that they don't surpass 2019 levels, making a certain assumptions around the pandemic and the macro economy.
Sure, definitely. And Jen, you were going to say something?
Yeah, no, one thing I wanted to ask our panelists, I mean, we've been talking about how luxury in the upper upscale is so great. I mean, do you think that it's durable? I mean, that's a debate that we ask ourselves every time we do an underwriting. I'm looking at a resort property right now, and it's having peak performance after this year. And so the question is can they continue to hit that ADR? And, they're even expecting a little bit of a dip next year, and then for it to gradually grow, but that's more based on inflation. So, that's one thing from a lender standpoint that we're looking at, is that we're in kind of a temporary period where, things look all rosy on the luxury side, but at some point things are going to dip. You're going to have to bring in more labor, which is going to increase expenses, eat into the margins, and what was permitted in 2021 because of COVID, that interaction with the customer or, having everything be done electronically, that's going to have to be balanced going forward, because you're going to have greater interaction, greater service, better service, and that is going to cost some additional dollars.
I would just to say, though, I think you two might be talking about different definitions of luxury, and the same with you, Jennifer, and the underwriting, because the luxury properties that the large public companies own are not the same types, by and large, are not the same Maui Four Seasons. Yes, some of them do have a one-off trophy asset, but in general, it's a more mass market luxury product that a public company would own. And I think those would be the ones that you'd be underwriting, Jen. But if we think about ultra luxury, labor costs can go up, they can double. It doesn't matter if you're charging, $7,000, $8,000, $1,000, $2,000. There's still plenty of opportunity for margin and cash flow at those levels. And I would also just point out, the S&P 500's up 30% year to date, and household checkable deposits have tripled during the pandemic. Yes. Can we expect to have 10% RevPAR gains into perpetuity? Probably not, but in this very small segment, people are flush with cash. They are richer than they have ever been. And talking about balance, the balance is get out of your house,
Yep.
right? We're all trapped at home 24/7. It's not the work-life balance that we used to talk about. It's like, I called my husband last night, and he works at a private equity firm. I said, "How was your day?" He's like, walked up to the desk, walk down, check the kids' homework, walk back to the desk. If that guy could get out of the house, in a minute, he'd be out of there. So I think it's just clarifying exactly what we mean, and because I think they can all be true. I think your stats are probably right, and yours are probably right too. And to answer Jen's question, we do expect continued upward trend in luxury. Maybe not as fast a pace as we've seen, but we do not expect to pull back.
I just want to make one comment. You're absolutely right. It depends on what your focus is. And we look at things, all real estate's local, so we look at things on an asset-by-asset basis.
Sure.
And we're always looking for what we call beachfront assets, like you said, or mountain. But ultimately, what I'm frustrated by in this country is our service model. Now, I'm going to ignore politics and all those elements, but the service model in U.S. business is dead. And I think people, when they get service, when they are treated properly, when people anticipate their needs, people are inclined to pay for it. I think there's like a service depression that we have here. And I don't know who delivers really good service in this country other than maybe luxury hotels or the high-end side. And I think that's really refreshing, that it's reliable, it's experiential, it's hopefully authentic, and it's something that takes you away from what you see on your cable news channel. And that goes beyond just what the asset class we're in. That is really what luxury is about. It's giving you that experience, and I long for it all the time.
Are you trapped at home?
No, I'm not. But service throughout this country is horrific. It's tragic.
So back to just real quick on the financing side, because I think you make a great point, Rachael. And from my point of view, with valuations and market studies and feasibility studies, when we're tasked with underwriting a 10-year pro forma for something that we don't know it's going to happen in 2 months, it's really difficult sometimes to get to a value that someone's really willing to pay. I mean, there is so much cash and just readiness and willingness to put their money somewhere. But to your point, in the sense of knowing what you can really achieve, and if the unachievable is now achievable, it's really hard when all you really have to base it off of is the most recent best year. So I hear a lot about the creative solutions that go behind financing deals and the conversations that go behind making sure things get done when not all parties necessarily are aligned, from a typical financing shop to the valuation that obviously has to happen for that person versus the person who's just ready to open their wad of cash and be like, here's my money, take it from me. So really interesting, and obviously as we move forward, it'll be interesting to see how it all shakes out. So looking forward, maybe we can do like just around the table or a down the line, I guess we could say. Sentiment for 2023 and beyond is I'll say luxury broadly, but if you want to particularly focus on whether it be the ultra luxury or just your mainstream branded luxury, upside, flat, what are your thoughts? And we can start with you, Jennifer.
I think we're positive on it. I mean, one of our focuses going forward is to really look at the health and wellness segment. There's a lot of money, and people are wanting to be healthier, live longer lives, have experiences, see mountains, see the ocean, and live and have eye-opening experiences. So I would say that we're very open to looking at things, and the one thing we would really just like to better understand is the sustainability of it, and some of that's going to be really case by case, looking at individual markets, seeing what their demand drivers are, and the captive audience.
Sure.
Yeah, I would echo that. I think I think the outlook is definitely positive. I see a lot of growth in the resort segment. A lot of the big brands are certainly focusing on it. I think the strategy from a branding perspective to get into the soft brands more and more is going to help with that growth. In terms of its general luxury development, I mean, lending is so cheap right now that if that can overcome sort of an offset of the increased cost to develop, I think you'll see more and more of that. There's less price sensitivity. And as long as service, I think, keeps up with that and doesn't create a bad taste in folks' mouths, I don't think there's any reason why rate would slow down. It's just a matter of occupancy, and those various segments coming back, which I think they will, certainly.
Sure. Smedes?
So, I mean, we obviously model out the public companies for several years. I mean, our 2023, I don't know that we're really underwriting specifically luxury. I mean, we're looking at RevPAR overall. For us, it's really an occupancy game. We've seen rates come back. Rate is basically back at 19 levels, but occupancy is way below. So we're assuming improving occupancy gains. For the companies that we follow, they're probably 35 to 40% leisure in terms of the overall demand component, and a significant piece of that would probably fall into luxury or luxury-like assets, even if they're not hard branded. So what's really important for our forecasts to be realized is really a return of urban transient.
Okay.
The business, just day-to-day business traveler, and basically groups, business-oriented groups. I mean, that's going to be all of the public companies have significant exposure to that segment. So we got to see that come back.
Sure.
I guess I would say that we're definitely bullish on high-end leisure travel. As a knowledge worker myself, my big adventure is to go down into the basement and ride the Peloton 4 feet from the wall. So getting out and seeing a mountain or two. And I don't even need pristine service, just any service. Somebody going to come and help me out. Oh, I don't have to cook and clean for my kids.
Go.
That's a win. So I am 100% bullish on that segment. I echo Smedes' concerns about urban, but I would also say that as you look at the high cost to operate markets and high tax markets in the northern US in general, even if it is to be a more leisure focused asset, we still have some concerns. Just given the migration patterns that took place during the pandemic with people moving south and to lower tax jurisdictions, we think that as group comes back, it is more likely to come back in the lower cost to operate markets first. Because if I'm sending somebody on a business trip, am I going to send them to a market where it's a $90 cab ride from LaGuardia to downtown Manhattan, and then it's a $300 hotel, and then a dinner out's $125? Or would I just put that convention in Dallas at the Crescent or the Mansion in Turtle Creek, where I can get an Uber for $18 and be right at the hotel? I can land a jet 365 days a year in sunshine. So we definitely see a divergence between the North and the South, and that could be sticky for some time.
Okay. Jay?
I too am very bullish, always optimistic. If you're in real estate development and the luxury hotel side of things, you're going to have to be an optimist.
Yes.
I think there's also basic macroeconomic factors that are also micro, in the sense that for really great resort, great luxury hotel opportunities, we're supply constrained. Ultimately, we'll find a way to live with COVID, or I don't know if we'll ever eradicate it, but we are learning a lot more about it. I'm glad to say Garcetti did not shut down LA with Omicron, which had been his tendency in the past. So it's a little more manageable now. But if you have one of these assets, they are irreplaceable, and I think you have pricing power. If you're looking to create some of these assets, that's the hard part, finding the right locations, because a lot of great locations are gone. And that's where you have redevelopment opportunities like what we have in Naples. We bought 125 acres that had been with the same family for 3 generations. That was an existing hotel. And we paid a high price for it. But it's been borne out with our real estate pre-sales even before we owned it. So I think long-term trends are always positive, and it's all about having the right assets. And if you got the right assets, you're going to always do well. And as long as you're not overburdened with debt, you can ride through some of these crises. I'm not sure what happens with the Fed and inflation. I know the Fed hates inflation, and I hope they don't go too far as they raise interest rates. But wealthy people, and there's been a tremendous amount of wealth, as Rachael pointed out, find a way to always do well, and now they're enjoying a lot of that wealth.
Great, great. Well, if we have any questions, we can take them now. But if we do not, then thank you all for a great discussion and panel. And if there's any audience questions, you should submit them. But I think we're going to trade it off now to your next panel.
Thank you.
Thanks, guys.